Hello, Business 600 Day students. This is Professor Hassey. Today's date is Wednesday, July 9th, and this is one of two videos this week to make up for the class that I could not attend this week, number 5, on Tuesday, July 8th. As I indicated, my wife has been ill the last few months, and we had to take her to urgent care yesterday morning and had to be with her for the balance of the day. She's a lot better today, but and resting, but she had a little bit setback this week, so we had to make sure we took care of that. So I apologize for not being in class on Tuesday or yesterday. But we're doing two videos. The first video is tonight, which I'll talk about the assignment 3 due this coming Sunday, and the first topic of the week, statement of cash flow. Then I'll do another video which will be posted on Saturday of this coming week, and that video will be about the case paper, which is highlighted by our second topic of this week's Chapter 13, Financial Statement Analysis, and that'll lead into our discussion of our case paper, which you all have now received or have, and that is due on July 27th. So we'll talk about those two things in our two videos this week. In addition, as I said earlier, we have an assignment due this week, assignment number 3. It's due on Sunday, July 13th, where I ask you to do the closing entries and close out or complete the accounting cycle for the company Rink Rats Incorporated. So I have a worksheet that I posted. Here it is right here, the worksheet. It's an Excel spreadsheet that I'd like you to download and do your work from the two documents. We're both a Word and a PDF document. They're both the same. And follow the instructions and post your work to that spreadsheet by this Sunday. I have all the grades updated through week 4 in your D2L. So all your grades are posted. Your cumulative percentage and letter grade are also posted in your D2L through our halfway point of our class. So please look those over, make sure they make sense to you. If you have any questions or concerns, be sure to get in touch with me either via email or if you'd like to schedule a Zoom meeting, that is not a problem through this week 4 and your grades in this course. Here's the assignment 3, which you're working on this week. It's the last of 3 assignments that have to deal with financial accounting of our course. And I give you the adjusted trial balance of a company. Then I'd like you to do a variety of things. From that adjusted trial balance, I'd like you to prepare an income statement, a statement of retained earnings, and a classified balance sheet as through the period of December 31st of that year. Noting that the retained earnings account at the beginning of the year, or the December 31st of the prior year, had a balance of $25,650. Then if you finish those statements, I'd like you to prepare the closing journal entries to close the books for that period of time, and then taking the remaining balances in the accounts and do a post-closing trial balance as of December 31st. That's what I would like you to do this week, and that'll finish our financial accounting section of our course. This week, week 5, we begin to talk about managerial accounting, financial statement analysis. We get into costing, internal controls, internal costs as we finish out our course this second half of this summer. Here's the worksheet that you need to prepare and download and prepare for assignment 3. I give you the adjusted trial balance of Rink Rats. There are accounts that are ready to go into the final part of the accounting cycle, all the debit and credit balances of the general ledger accounts. From this adjusted trial balance, you complete the income statement, the retained earnings statement, the balance sheet, and finally, once those statements are complete, you do the necessary closing entries. Naturally, the date will be December 31st. Necessary closing entries, And once those closing entries are completed, then you show the remaining balances that you've adjusted from the adjusted trial balance of what accounts you closed. And those new balances will now be in the post-closing trial balance, the remaining accounts that will go into the next fiscal year for Rink Rats Incorporated. So that's what I'm looking at. In my grading of this, 20 points for the income statement, 15 points for the retained earnings statement, 20 points for the classified balance sheet, 25 points for the closing entries, and 20 points for the post-closing trial balance. You don't have to worry about the headings. They're all there for you. The proper headings to these statements. All you need to do is fill in the numbers and close the books. And this will complete our financial accounting section of this summer class through chapter 4 of the textbook. Now we get into the second half of the class, week 5, where we learn about managerial accounting, financial analysis, taking a look at costing, taking a look at finance and its relationship to accounting, this last section or last 4 weeks of our course. You know, as we head into the second half of our Business 600-day class, Accounting and Finance, now we're getting into the area of your MBA study where the accounting data is complete. Your job is to analyze it. Analyze it for trends, analyzing it to compare to your competition, analyzing to show and to understand where your cash comes from. Because remember, cash is the blood of a company. Without cash, you can't pay your bills. Without cash, you can't invest or acquire new assets to grow. Without cash, you can't distribute your value to your investors, dividends, paying off the loans, interest. So understanding that is very important for our second part of the class because this will lead us into the finance side of our course. Understanding our costs in relationship to pricing, understanding our costs in relationship to understanding what it costs us to produce or provide our services. That is very important, and that's what we'll be concentrating in the second half. So as an introduction, that's what week number 5 is all about, determining the uh, key areas of switching over from accounting, financial accounting, to managerial accounting and finance, and that's through the statement of cash flows and financial statement analysis. Statement of cash flows is chapter 12, and financial statement analysis is chapter 13, and also highlighted in the case paper you have to do about the company you have selected for our course this summer. And I will have more about that in our second video of this week number 5. But first, let's take a look at what statement of cash flows is and how important it is to us as business strategists.
A lot in the business world about the balance sheet, aka the statement of financial position, and you'll hear them talk a lot about the income statement with the earnings figure that publicly traded companies need to disclose to investors every quarter. But you won't hear as much about the statement of cash flows. And that is a shame because the statement of cash flows is one of the most important financial statements when it comes to analyzing a company's performance. So what does the statement of cash flows tell us? It tells us why a company's cash balance increased or decreased during a period. This is important because cash management is absolutely critical. It is the most important thing to the survival of a company. A company cannot survive without cash. If a company runs out of cash, they won't be able to pay their employees. They won't be able to pay their utility bill. They won't be able to pay for inventory if they're a retailer. So they need cash to survive. If they ever run out of cash, that is the end of operations for that company. So it is absolutely critical to understand what is going on with the company's cash. Why did it go up? Why did it go down? We can always tell what the cash balance is by just looking at the balance sheet, right? Because cash and cash equivalents, that's going to be a line item on the balance sheet. That'll tell you how much cash the company has at any given point in time. But we want to see from one period to the next, why did cash go up or why did it go down? Let's say the cash went up for a company by $80 million. And you say, oh, great. You just said the cash is critical, and cash went up by $80 million over the past year, so this company must be doing great. Well, what if I told you that from that company's main business operations, they lost hundreds of millions of dollars in cash, and that the only way that the cash balance ended up going up by 80 million is because the company borrowed a ton of money? Would you be as excited about the company's business operations? So we want to understand, where is the cash coming from? It went up by $80 million, but why? Did they generate a ton of cash from selling inventory or providing services? Is that why cash went up by 80 million? Or is it that they borrowed money? Did they issue stock to investors and that's how they got the cash? Maybe they sold off the fixed assets or some investments. So we want to understand the sources of the cash flow. And then we want to think about, at a deeper level, are those sources of cash flow, are they sustainable? Is that something we're going to be able to rely on? If the company's getting all its cash from borrowing money, is it going to be able to do that forever? If they're consistently just losing a ton of cash for their main business operations, are people just going to lend this company money forever as it burns through cash? Probably not. So we've got three sections of our statement of cash flow. So we've got the operating section. Okay, we got the investing section, we got financing. So all the cash flows are going to be grouped either as operating cash flow, investing cash flow, or financing cash flow. I like to think about operating cash flow as basically the company's cash basis net income. And when you use the indirect method, which is what most companies use to prepare the statement of cash flows, you actually start with the company's net income from its income statement, and then you make some adjustments to it to get to basically cash basis income. For example, you would take out credit sales, because credit sales increase net income because of accrual accounting, right? We recognize the sale even though we don't have the cash yet, but we don't have the cash yet. So we want cash basis net income. We would deduct from regular net income. We would subtract any increase in net income due to credit sales. So we basically back out the credit sales. So you're getting cash basis net income. Okay. Now, investing, cash flows in the investing section, that's the company, so if you hear about capital expenditures, for example, okay, CapEx, capital expenditures are a cash outflow in the investing section. That's where you'd see CapEx. Like, let's say it was Walmart and they were investing money to build new stores, new retail stores. So that would be a cash outflow of purchase of property, plant, equipment in the investing section. If they sell off or for purchase any investments, if they dispose of fixed assets, all that's going to be in the investing section. Financing is so transactions with owners and creditors. What I mean by that is, so with an owner, it'd be like if they're paying dividends to shareholders, if they're issuing stock and shareholders are getting stock, and then they're giving cash to the company. So the company would have a positive cash flow from financing due to issuing stock, whether in an IPO, a seasoned offering, whatever. Creditors, so if the company borrowed money, that's going to be a cash inflow in financing. If they're repaying debt, that's going to be a cash outflow in financing. And so here's some more examples. Some of them I already mentioned, but just to give you an idea of the type of cash flows. Again, think of operations, cash flow from operating activities, also known as operating cash flow. Okay, that is one of the single most important predictors of a company's financial health, is thinking about operating cash flow. Is that company able to generate on a net basis more cash than they spent in whatever their main business operation is? So for Walmart, that would be acquiring inventory and selling it in their stores. Okay, so when they're buying and selling inventory, is Walmart able to generate positive operating cash flow? Okay, if it's not, then we've got a problem. Okay, so as I mentioned, there's two different ways to present this statement of cash flows. And the nice thing is that the investing section and financing section are identical, whether you do it either way. Okay, the only thing that matters is the way that the operating section is presented. Okay, so the indirect method, this is the one that I'm going to focus most of my time on. I really suggest that you learn. Again, you start in the operating section with net income from the income statement, and then you make some adjustments, like you add back, like for example, depreciation. Why? Depreciation's an expense. It reduced net income, but has no effect on cash, right? It's a non-cash expense. Okay, and then you add back, you make other adjustments, like working capital accounts. Like I said, if there was an increase in receivables due to credit sales, you're going to back that out and so forth. Okay, so you get to the operating cash flow, okay, which I like to think of as cash basis net income. So I think it's more intuitive with the indirect method. You're converting accrual basis net income to cash basis profit or loss. Now, the direct method Some people prefer a very small number of firms actually use the direct method, but you get to the same place. What I want to emphasize is operating cash flow, either way, the number will be the same. Okay, it's just the way it's presented. So you do it this way or you do it this way. Either way, you're going to have an identical operating cash flow. It's just the way the operating section is presented. So again, I'm going to focus on the indirect method because that's what the overwhelming majority of companies use. Now, again, what are we doing with the statement of cash flow here? Well, we're trying to predict future cash flows for the company. Why would we care about future cash flows? Well, one way to value a company is using a discounted cash flow, right? So we can do DCF analysis. We'll calculate something called free cash flow for the company, which I'll make other videos on. But we can calculate free cash flow and think of the company as a stream of cash flows into the future and discount those cash flows back to present value, add them all up, and you basically have an estimated value of the firm. You can also think about the company's ability to pay dividends. And if you're thinking, well, what if they were to borrow more money? Would they both pay? Are they going to be able to have enough cash to update their stores and keep their stores nice and clean if we're talking about a retailer? So thinking about what the cash flows are going to be in the future. Again, if we've got positive operating cash flow, that's a great thing. If we have negative operating cash flow, then it's like, we're not able to stand on our own 2 feet, generate enough cash from our business operations. We're either going to have to borrow it, we're going to have to issue stock, or we're going to have to start selling off some investments or fixed assets. Now, when we look at a statement of cash flow, you can see exactly where a company is at in its life cycle. And I've got some examples of that just to give you a general rule of thumb. And I'm just going to walk through it quickly. We'll get into this more with specific companies. But let's say you have a startup. Generally speaking, if you have a startup company, you would expect the operating cash flow would, in initial stages, be negative because the company's just getting going, right? You don't expect them necessarily to have positive cash from their business operations yet. So they have negative cash flow from operating, negative cash flow from investing. That's not a bad thing, by the way. Negative cash flow from investing for a startup or a mature firm, negative cash flow from investing is fine. You want the company either trying to expand or, like I said, if we're talking about Walmart, if they're not necessarily building new stores, but maybe keeping their existing stores clean. So it's fine to have negative cash flow from investing. It's actually a good thing. The company's investing in the business. Now, a startup, getting back, so they have negative operating cash flow, negative investing cash flows. They're building out the company, and then positive cash flow from financing. Because they're in the early stages of startup, you see they're getting money from either borrowing it or getting it from investors. Now, a mature company, you expect them to have positive operating cash flow. If they don't have positive operating cash flow and the company's been around a while, then you say, okay, they're more likely to be in distress. Okay, a company with negative operating cash flow has been in business 30 years, and if they have positive cash flow from investing and negative cash flow from operating, that's really a company in distress because they're not able to generate cash from their main business operations, so they're having to sell off fixed assets. And so that'd be like a company like JCPenney or something having to sell off stores, sell off fixtures. It's like, hey, don't you need that stuff to make money? And they're like, well, we're not making money from our main business, so we have to generate cash by selling off some of our stuff. Okay, so that's just an overview of how we can think about the life cycle. Now, let's dig into an actual statement of cash flow here. So we've got Walmart, and we actually have three statement of cash flows here. So we got for 2021, 2020, and 2019, each for the fiscal year ended January 31. Now, as I said, most companies use indirect method. Walmart is no different. So they start with net income. Okay, this is the operating section here. Okay, you got operating section, investing section down here, and then financing. So the operating section start with accrual basis, net income from the income statement. They had $13.7 billion of profit for the fiscal year ended January 31st, 2021. And then you make adjustments. You add back depreciation and so forth. Okay, they get to $36 billion of operating cash flow. Okay, that's a lot of operating cash flow. Okay, now we look at the investing. Cash flow from investing is negative $10 billion. That's fine though. That's fine. That's not a problem. Payments for property, plant, and equipment. Maybe they're building more stores. Maybe they're updating existing stores. Maybe they had a fleet of trucks and they had to replace some of their trucks. Whatever. That's fine. This is not a problem that they have negative cash flow from investing. Now, cash flow from financing could go either way for a large company like Walmart that's successful. Now we see in this case it's negative, but that's not a bad thing. Why is it negative? Well, repayments of long-term debt, so they're paying back some of the debt that they borrowed. Dividends paid to shareholders, so they paid out $6 billion of dividends. And then they repurchased some of their stock, $2.6 billion. So that's fine. That's good. If you're an investor, hey, they're paying their debt, they're issuing dividends, they're repurchasing shares. So just because you see a negative number for cash from financing or cash from investing, that's not a bad thing. That's not a bad thing. This company has positive operating cash flow, and this is what, so you see now what is happening with the company's cash during the period. They're generating plenty of cash from their operations to stay in business. They're not having to borrow tons of money or whatever. They're not existing because people are lending them money. They can stand on their own 2 feet with the cash flow they're generating. They're updating their stores. They're making investments. They're paying dividends and so forth. So this is what is happening with the cash from Walmart. Now, companies will dollars during the period. And you see that is added as a working capital adjustment. And I've got other if you're wondering, like, how does he actually make a statement of cash flow? How does I've got other videos on that if you want to check it out. But long story short, when there's an increase in a current liability, like accounts payable, that's going to be added back as an adjustment to net income in the operating section. So you see that basically increased the operating cash flow almost $7 billion there, right? And then the question is, well, is that sustainable? Why would it happen that account payable go up by $7 billion? It wasn't like that last period or the period before. That's a big jump, right? So last period it was almost flat and then went up almost $7 billion. What is that? Well, delaying payment of vendors, right? That's one way the account payable would go up, is you're just delaying payment of vendors. Now, you're waiting longer to pay your suppliers. Not necessarily a bad thing. And you might even say that's a great idea from, hey, if they'll wait longer to take the money and we don't have to pay any kind of penalty for that, hey, that's great. But you got to think about it like this. Is that a sustainable source of cash flow? So let's say, I'm just going to make up a number off the top of my head. Let's say that they were willing to wait 40 days to get paid this period. Can we go to 50 days? Can we go to 60? Maybe. What about 120? Now, okay, come on. Let's not get ridiculous here. So we want to think about how the sources of cash flow is sustainable or not sustainable. We're going to dig into this and a lot more when we get a higher level with manipulating the statement of cash flow and thinking about the line items therein. In this video, we're going to talk about the purpose of the statement of cash flows. So investors have a tendency to fixate on net income. They say, what's the bottom line? Is this company profitable? They calculate things like ROA, ROI. But it's important to remember that net income is an accrual-based number. That means that there are certain things in net income that we hope will map into actual cash flows at some point in the future, but may in fact not. So for example, you make a sale on credit, you debit accounts receivable, you credit sales, and this is going to increase your net income. However, what if you don't collect these accounts receivable, right? If it doesn't actually turn into cash flow, that could lead to serious problems for your firm. And that's led to a lot of people saying things like cash is king. And what they mean by that is the following. So a firm doesn't necessarily go bankrupt when it posts a loss or posts a series of losses. Firms go bankrupt when they run out of cash. So cash flow is the most important thing for a business. And so the statement of cash flows is going to tell us basically where the firm's cash comes from, what are the changes in the firm's cash during the period, what are the sources, and so forth. So it's a really important statement, understanding a firm's liquidity. So if we look at just the basic structure of a statement of cash flow, we're going to have the change in cash flow, but that's not as important because we could have seen the net change in cash flow. If we just looked at the balance sheet last year and then the balance sheet this year, we could see what happened to the cash account. So it's not just that we see the change in cash flow, it's by breaking it out into cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. When we can look at these different things, we can say, okay, where is the cash coming from and where is the cash going to with this business? So let's walk through an example to make it a little bit easier for you to understand. So let's say we've got a company called Fast Money Technologies and that they have net income of $1.2 million. So this company is profitable, right? So they have a positive net income. So people might be excited and say, hey, that's a company worth investing in. And we look at, let's say we look at last year's balance sheet and we look at this year's balance sheet and we see that, hey, cash account actually went up $25,000. So now things are looking pretty good, right? We've got a profitable company and their cash is actually increasing. So it doesn't look like there's any problem with cash flow, right? Well, that's where we want to do a statement of cash flows and see exactly what's happening. So here's just a really abbreviated statement of cash flows, and I just have the three main things here. We've got our cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Okay, so when we look at the CFO, the cash flow from operating activities, we see it's a negative $275,000. See, the fact that I've got it in parentheses here means it's a negative number or a use of cash. So that means that when we just look at the cash generated by the operating activities, it was actually negative. So the operating activities used up cash, right? So the net effect was a use of $275,000 of the firm's cash. So you might say, hey, wait a minute. How is it that we can have $1.2 million in net income and then our cash flow from operations is negative $275,000? Well, that's because net income includes accruals, right? Remember, like we just talked about, let's say that you had a bunch of sales that were on credit, and so you have a really high accounts receivable balance. That's going to boost your net income as you make all those sales, right? But now until you actually collect those sales, right, you don't have any cash flow from operations. So this is just reflecting the difference between this accrual-based number and then this cash-based number here, right? So there are any number of reasons. I mean, it could have a big buildup in inventory and so forth. But in any event, we've got this cash-based number here. This cash flow from operations is negative, and then we've got a positive profitability number. And now, so you say, well, how is this firm staying, if they're generating negative cash from their operations, how are they staying afloat? Well, they don't have anything going on with their investing activities, but if we look at our financing activities, they have $300,000 positive cash flow provided by their financing activities. And let's say that we take a look a little bit, we look a little deeper and we see that that's from a loan. So they borrowed money from a creditor, right? So they borrowed money from a bank or so forth. They borrowed $300,000. And so that's what's accounting for this increase in cash. So if we just looked at comparative balance sheets, we'd see, oh, from last year's balance sheet to this year's balance sheet, we went up $25,000. Everything might be going wonderful. But now we see that, well, you know, we do have cash. Everything's fine, right? But we got $300,000 of it from the bank, right? So the bank gave us that money. We're not generating it from our operations. We're actually losing money from our operations. We're losing cash. Now, that doesn't mean necessarily just because you have negative cash flow right now that the company's a bad company and you shouldn't invest and so forth. It might be, okay, they collect all those receivables next year and everything's fine. But this is just kind of like a red flag, right? We want to take a look and say, wait a minute. Do we think that all this net income, the accruals, are actually going to map into cash flow? And do we think, for example, that this firm with this loan, do we think, for example, that they'd be able to meet their first interest payment, or are they going to have to come back and borrow more money from a bank or raise money with a stock issuance or something, right? Are they going to have to get equity? So basically, we have to think about these things, right? They have a loan, so now they're going to have an interest payment, right? And so if they're not generating positive cash flow next year, so let's say next year cash flow from operating activities is also negative, then that means that they're not going to have the cash from the operations to make the interest payment on this loan. So what does that mean? That means they're going to have to go again and say, okay, well, we got to borrow more money from the bank and this, or do that stock issuance or something like that. But what if the bank says, look, we're not going to lend you any more money, or what if credit dries up or so forth? Then they might say, well, in this investing, we could sell off some of our assets or something like that. But do you really want the company selling off its machinery and so forth to pay this loan? I mean, they use the machinery to generate, ideally, cash flow from operations. So it's just something to think about. And remember that the statement of cash flows isn't just telling us about the change in cash, right? We don't want to just know delta cash. We can get that from comparative balance sheets. It's telling us what happened and why, right? So we're seeing the sources. We're seeing that this firm is not generating cash from its operations, at least not right now. They're actually they're getting all their cash from financing. So just because they have increased cash and they've got positive net income doesn't mean that this firm isn't going to go bankrupt, right? It just could very easily be that they don't generate any cash flow from operations next year or the year after that either. And at some point, the bank says, we're not going to loan you any more money, and they just run out of sources of cash. And then when the firm runs out of cash, they go bankrupt, regardless of whatever accrual-based net income number they happen to generate.
Okay, those are two good videos highlighting statement of cash flow and why is it important to us studying accounting and finance? Because as the gentleman said, and I agree with him in using the indirect method, which most companies do, the indirect method of cash flow, treating net income as an accrual. What it tells us, it's the transfer of information and analysis from what happened with the financial statements, income statement, balance sheet, to where we're heading to in the future and are we sustainable? And that's the statement of cash flow. And that's further highlighted in the financial statement or trend analysis of certain key variables, which we'll talk about in our Saturday update video, which will relate to your work in your case paper assignment. So the key thing about statement of cash flows, and I know the gentleman talked a little bit too fast, but those are great videos highlighting our chapter 12 discussions and taking the key points, what we need to know about cash flow and how it helps us as a manager, as an investor, interpreting the performance and the efficiency of a company. And that's the key part of our study this week. The second part of that is, okay, what does it tell us in comparison to trends? How do we compare to our industry? And that's the second video of our discussion on Saturday, financial statement analysis. So again, we're working on assignment 3, which is a little bit different than what we're studying this week. Assignment 3 is completing the accounting cycle. That's due on Sunday. This week, we're learning about reviewing and determining the efficiency of cash management and our trends and where our company is headed into the future in this week number 5. Until this weekend, have a great rest of the week, and I'll talk to you then. Adios.